The proposition is that without a return to a significant degree of social interaction and movement of people, economies cannot harness their full and optimal capacity to produce goods and services, and in turn, the equity market's abundant enthusiasm will have been misplaced. To be sure, I think this is less of an issue for Europe, the UK and US, but for Australia we see real risk that governments fail to grasp and comprehend how to normalise movements between significant vaccination with commensurate adverse economic impacts, which both Gerard and I will touch on. We view the prospects for social interaction normalisation is significantly diverged between Australia and the increasingly vaccinated regions such as Europe, the UK and the US. As matters stand, the UK provides the most optimistic path for developed economies in Australia. But we'd be the first to admit that the UK's path for getting to this point was horrible and littered with policy blunders. In the UK, the adult population is now approximately 90% first dose vaccinated and 70% double dosed, and 1 in 5 of the population estimated to have contracted COVID. Whilst herd immunity may no longer be possible, nor the objective, such levels of vaccination and antibody, based on the available data, provides the necessary combination of immunity and protection from serious illness and hospitalisation. This confronts the reality that once vaccination rates reach greater than 70%, the policy objective could move to substantially protecting the community. Vaccines are, of course, not complete protection from hospitalisation, delivering a 90 to 93% efficacy rate. In the UK, that would leave 4 million double vaccinated adults susceptible out of 41 million. But sensible mitigation such as booster shots, social distancing and masks substantially reduces this further. The difference in policy objectives of protection of community versus suppression to zero is stark. The economic outcomes even starker. Regions such as Europe, the UK and the US have largely crossed the Rubicon into protection through vaccination. Australia is still firmly in the small camp with New Zealand of suppression to zero. Our concern for Australia is that it diverges significantly from this credible opening path provided by the UK experience and data. We haven't arrived at that point yet and hope we don't, but like the RBA, agree that the downside risks are building. And the downside scenario here clearly demonstrates a growth trajectory that will be lower than pre-COVID growth levels and a poor outcome given where we were earlier in the year and the level and vast cost of stimulus to this point. Other than the policy question of our normalisation of social interaction and movements, we do remain cautiously optimistic with the core foundations for rebounding growth still in place through stimulatory monetary policy and abundant government fiscal support. The market rebound over the last 18 months is one that any Olympic gymnast would have been proud of. Over the last 12 months, Cameron Harrison's increased exposure to market risk across domestic and global equities and industrials has been increased. We retain this stance at present, which reflects our cautious optimism for market risk over the outlook period, but is highly selective and focused to dynamically conducted industrial and service firms. New capital is being cautiously deployed through staggered investment. In terms of accounting for our strategy performance, we've performed very well over the full spectrum of time periods from 1, 3, 5 and 10 years. As private investment managers, we've navigated many cycles and market disruptions, from the 1990 recession, the dot-com era, GFC, COVID, and now post-COVID navigation. Core to this sustainable success is that we operate our investment strategy with consistency and conviction and dispassionate analysis, often when it's unpopular or contrary to the prevailing momentum trade or fad. For the period ahead, this heat map shows our stance on relative asset class positions. We're moderately pro-risk with our asset allocation, with allocation to equities and listed property retained at the expense of bonds, due to reasonable yields for market risk and our bearish view on bonds over the medium to long term. We retain a pessimistic view beyond 2022 on commodities, and particularly China demand and Brazil supply normalisation for iron ore. Also, with inflation a particular watch point, large latent cash allocations should be protected for purchasing power. Overall, we have a cautious view of investment and economic conditions for the year ahead, but no forecast is without risks, and our balance of risks are mindful that we have finished the last chapter, which has run for some 25 years. And we are now in a completely new chapter for which of many of the old assumptions and conditions just simply don't apply. For the 6 to 12 month outlook period, we would highlight what we describe as our 4+1 key watch points. Firstly, inflation and wages growth. Services are central to a modern economy, and it is the potential for services inflation feeding wages inflation, which we carefully watch going into 2022. On balance, we expect rising bond rates, which would adversely impact bond markets and also to some extent risk markets, reversing a 25-year golden era for markets. Delta and the vaccine. Delta has reminded Australians of the economic risk of lockdowns, but timid political leadership in Australia, even at greater than 70% vaccination rates, risk growth rates being lower than our mid-case and where we were pre-COVID. Thirdly, monetary policy tapering and tightening of US interest rates. We feel that the taper can be managed, as can some normalisation in interest rates. But the major risk is that inflation is allowed to overshoot for too long and that the Federal Reserve acts late and too hard. Fourthly, in terms of fiscal balance, Japan's experience and that of Europe post the GFC has shown a tendency to withdraw fiscal stimulus too soon rather than too late, though this risk seems to be minimising both here and in the US. And our +1 is China. Firstly, China in terms of capital allocation and the sovereign risk occasioned by the approach of the Chinese Communist Party. Secondly, a risk through US policy of a decoupling between the West and China and particular implications for supply chains. And thirdly, geopolitical tension concerning Taiwan. These are our major watch points. They're significant, but as I said, it gives rise, we think, to still mild optimism for the year ahead and for risk markets. But it is in the context of a changed world and a new chapter for economies and for markets. So it's my great pleasure to welcome our guest speaker, which is Gerard Minack, to, as always, give his thought-provoking views, opinions, to prod us and to make us really think of those things that are not perhaps necessarily in the mainstream commentary. So welcome, Gerard.
Thanks, Paul. Great to be here, although, as you said, I'd rather be doing this live in a more convivial as you normally do. So hopefully that's the 2022 story. I want to talk about two things today, and broadly it's the globe versus Australia. And the global story is relatively upbeat, at least in a macro sense. There are some risks around markets, and then we'll turn to Australia, as the heading suggests. We've won the COVID war, but we risk losing the peace. Arguably the most bullish and important chart I want to show everyone today is this one. And this is the UK experience. And it shows that vaccines work. In the UK, their vaccination coverage has also been boosted by the fact that so many people have got the disease. So combined, there's quite high immunity. Boris Johnson's conducting a little experiment. He's announced Freedom Day. As you can see from this slide, that's led to a new wave of infections. But the key point is hospitalisations and deaths remain quite low. If this is the experience that continues, it tells you that there is a light at the end of the tunnel, and vaccines ultimately work. That means we're looking at a robust global macro recovery with some differences from what we saw in the aftermath of the GFC. The first thing is we've seen massive fiscal stimulus, but it's been led by developed economies. This slide shows the IMF's estimate of discretionary fiscal easing. The two things I've highlighted on the bottom are emerging markets on the left, and their stimulus has on average been less than 5 points of their GDP, versus developed markets on the right, which is over 15 points. And the US is 25% of their GDP. And it's worth recalling that the US is still 25% of the world's GDP. So that equates to 5% of global GDP. And that doesn't yet count the fiscal, the infrastructure spending initiatives that the Biden administration want to push ahead with. So we're seeing a big lead here from the US in particular, but developed markets also in stimulating aggressively. There's a second thing that's cementing developed market leadership of this recovery, and it's the rollout. We're not going to call it a race, the rollout of the vaccines. The numbers I'm using here are for total percentage of the total population, not just the adult population. And the UK, as mentioned, is at around about 60%. Now that's leading to this developed market-led recovery, which contrasts to the GFC recovery, which was very much led by emerging markets generally and China specifically. This slide just shows very simple measures of macro strength, the so-called composite purchasing managers indices. We're blending together manufacturing and services. And you can see how strong the developed markets are, both relative to their history and relative to emerging markets. Now, this is not news to financial markets. And indeed, we've had a terrific rally in equities from the lows last year. The S&P last week precisely doubled the level it got to in April last year. So it's up 100% since April. This slide is showing you in red global equities overall. The blue line is consensus expected earnings. Now, both earnings and the index have rebounded from a year ago, but what's obvious from this is the index has rebounded far further. In other words, the market has said, yes, we're having a recovery, it's priced in a recovery, and it's priced in even more. And therein, I guess, lies the risk of some correction. But the far bigger issue for the sustainability of this cycle and what could put a big dent in equities is any concerns about uncomfortable levels of inflation. And I want to spend a few minutes on that because this is going to be decisive for market behaviour and for central bank tightening. And the simple story I'm going to make to you is that there is going to be two waves of inflation in this cycle. The first wave, which I think is coming close to peaking, is transitory, to use the phrase du jour, and it's centred on the goods sector. The second, more dangerous wave I'll discuss, because it's going to be led by housing costs and labour costs. Now, this first wave, the goods-driven wave, has been larger than many, myself included, was expecting. And that reflects one of the many unusual features of this downturn. This chart shows input prices and delivery times as reported by global firms. When the lines are low, input prices are falling and delivery times are fast. And you can see around 2000, 2008 in recessions, that's exactly what happens. With spare capacity, prices fall, deliveries speed up. This time was different. If you look what happened in the pandemic, because the pandemic had both demand-side shocks and supply-side disruptions, delivery times, rather than speeding up, actually slowed down. And as the recovery took off, we now have delivery times as slow as we've ever seen in the last 2 decades. In other words, that blue line is higher than we've seen on that chart. And that reflects the supply disruptions created by the disease itself. Now, this is leading to something very unusual. It's quite typical for early in a cycle that factory level, producer level inflation picks up. The unusual thing is the degree to which it's being passed on onto consumers in this cycle. Now, if you think that would be normal, you're wrong. This chart shows the level of consumer goods prices in the US, and you can see the steady increase in the factory level price, the blue line, but there's been a complete disconnect since around 2000 in the prices actually paid by consumers. Right now, however, you can see that we've seen a pickup in consumer level goods prices, which have actually increased by more in the last 15 months than they have in the preceding 23 years. So what made this cycle different? Well, it was those supply disruptions that gave people selling goods to consumers an unusual degree of pricing power. And the reason for that's fairly straightforward. They ran out of stuff to sell. This chart shows inventory to sales ratios in the US, and at the retail level, inventory to sales fell to all-time multi-decade lows. Now, this factor was most pronounced in the auto sector. Autos enter the American inflation gauge in 3 components: the price of new cars, the price of used cars, and the cost of renting a car. Let's see what impact that has had on inflation in the States. Well, the red line on this slide shows that the core inflation rate in the US has jumped to 4.5%, which is the highest in almost 4 decades. But if I pull out those auto components, core CPI is just at 2.3, which is right back to where it was pre-pandemic. In other words, the auto sector's had an outsized impact on inflation. But the key forward-looking point is this is without a doubt a transitory influence. To be fair, I'm not sure whether getting the cars back into the sale yard will take 1 month or 1 quarter or 1 year, but it's certainly not going to be a permanent increase. And indeed, once the supply blockages are removed, I would expect that the auto-related prices will actually start to fall, and these things will start to subtract from core inflation. The Fed, investors, and the way market pricing suggests, everybody believes this is transitory, and I clearly share that belief. It's the second wave that's going to cause this problem, the second inflation wave. And the second inflation wave really is the main game. Normally in the US, the bulk of core inflation comes from 2 components: shelter prices and services. And one of the things this chart hopefully makes obvious is that these things tend to trend. They tend to persist. it would be impossible for a central bank, if these factors start to rise, to dismiss them as transitory. These will require the Fed to respond if they push inflation to uncomfortable levels. That, I think, is a prospect over the next couple of years. And I will give you some guidance on timing. But just to have a look at what's going on here. Firstly, shelter prices. The blue line here is the rent paid by people, renters. It fell significantly or decelerated over the last 12 months. But that asking rent indicator obviously is pointing for gains ahead. Now, what landlords want, they don't always get. But typically, if they are pushing up their asking rent, it does ultimately feed through to actual rents paid. So I think we're going to see rent inflation pick up over the next 12 to 18 months. But the main game, in my view, is going to be service sector prices, which are overwhelmingly driven by labour costs. Now, the reason I think this is the main game is that the Fed is now trying to achieve two things with its monetary policy. The first is the thing it's been trying to achieve for 2 or 3 decades, which is an inflation target. But it's now elevated full employment as a dual objective. Now, as you may all know, you potentially have a problem if you've got one instrument but 2 targets. And this is a problem for the Fed, it's a problem for the RBA, which likewise, like the Fed, is aiming for full employment and an inflation target. The way I think these banks are going to overcome that potential problem is to adopt what the RBA has made explicit. The RBA has told us that it will not tighten monetary policy until wage growth is running at a level consistent with its inflation target. In other words, the way it's going to handle having one instrument and 2 targets is it's going to sequence the targets, and the first prime target it's going to aim to achieve is the full employment target. And that's why this chart is so important. This is effectively where the Fed's 2 objectives, full employment and its inflation objective, overlap. It's the link between labour costs and service sector inflation that gives a way for the Fed to make the 2 objectives consistent. This in turn means I think labour market data are going to stand head and shoulders above everything else in terms of determining when the Fed will need to start tightening monetary policy. So when's that likely to be? Well, it's when we get to full employment. When's that? I'm not sure. There is a relationship between unemployment and labour costs, the so-called Phillips curve. The problem is the relationship can change over time. This chart shows this relationship. The purple line here is the Phillips curve that emerged in the aftermath of the GFC. If we are still on that curve, then it will probably require an unemployment rate down towards 3% before we get the sort of wage growth that is consistent with the Fed's inflation target. If, however, the economy has moved back to the blue line on this slide, which is the Phillips curve that operated prior to the GFC, then the unemployment rate will not be able to drop as low. And we're potentially talking about the Fed needing to tighten rates late in 2022. So it's a huge issue. Which curve are we on? Now, the red dot is the latest observation, but never put too much weight on data for 1 month. I don't have a strong view as to what curve we're going to end up being on, but I do think we'll get some suggestive evidence over the next quarter or 2. What's going to happen over the next quarter or 2 is we're going to get a sense of how much labour supply in the US has been reduced by the pandemic. What we've seen over the last 15 months in the US is a large decline in labour force participation. And most people attribute this decline to 3 factors. And what we should find out over the next 3 or 4 months is at least how important two of those three factors are. The first factor that's probably had a role is older workers, the over 55s, so the two bars on the far right of this slide, have taken early retirement. It's all been too hard. And there we have seen a very large fall in labour participation. Now, that may end up being permanent. But the two other factors, we don't know how persistent they're likely to be. The first is that the US has been paying higher than usual unemployment benefits. Now, these higher payments expire in September. So if this has been a big factor in the reduction in labour participation, we should see that start to reverse through the December quarter. A second factor has been closed schools and the difficulty getting child minding. And you can see the two big red bars in the middle of that slide is the decline in female participation for 25 to 34 and 35 to 44-year-olds, classic stay-at-home mums. If this has been a factor, you would expect to see that female participation improve over the balance of this year. So let's see what the evidence suggests. What I will say is the market is expecting that we will start to see small Fed rate increases by the end of next year. That's the red line in this chart is showing current market expectations. The purple dots are the Fed's own forecasts. So the market for now is more hawkish than the Fed. If we do get inflation rising, a second wave, a more persistent rise in inflation, and we do see the Fed bring forward its likely rate increases, we're almost certain to see a lift in long-end yields, bond yields. In fact, already bond yields are looking anomalous compared to the strength of the cycle. This chart is just showing you the US 10-year Treasury yield compared to the Global Manufacturing Purchasing Managers Index, just a measure of the global cycle. And that's suggesting that yields should be a lot higher than they are at the moment. So my view is what we're likely to see either by late next year or certainly in 2023 is the Fed starting to tighten. And I think what we will see through the course of next year is bond yields trending up towards 3%. Now, this doesn't necessarily spell disaster for equities, but it may well adversely affect the more expensive parts of the market, whereas the prospect of stronger growth should help the more cyclical parts of the market. In other words, what we've been talking about, the reflation trade, I think has another leg to it. If you look at global equities, the US market is the standout expensive market. The measure I'm showing here is just comparing the index to expected earnings. This is actually a measure that tends to flatter the index because expectations are quite high. Most other absolute valuation metrics for US equities are now either at all-time highs or have only been exceeded once in prior history, which is at the top of the tech bubble. The rest of the world looks far cheaper. In other words, this is a scenario where US equities will start to underperform and the rest of the world, my personal favourites, Europe and Japan, should start to do better. It's also a scenario where I think we'll see some sector and stylistic rotation. In particular, I think the more expensive growth stocks and sectors do look vulnerable to any lift in rates. They have seen an unusual re-rating over the last 2 years in the period of lower rates. They did start to derate a little as bond yields increased at the second half of last year, but have started to recover again with the recent declines. So that's a real point of vulnerability. I'll leave it there for the world. I want to turn now to Australia. And as I mentioned, I fear that we're at risk of having won the COVID peace, but winning the COVID war, but losing the peace. We've done a great job so far. By the end of July this year, Australia was right down the bottom where you want to be in terms of deaths and infections. That went hand in hand with actually fewer restrictions than many other countries. This chart is just a snapshot of whether you've been under aggressive restrictions, the red, intermediate, the yellow, or no restrictions, the green. The way this has been calculated for Australia is to take the state that's got the most severe restrictions. So if I was showing you this for WA, for example, they'd be looking like Taiwan or New Zealand. So we've had a better health outcome with fewer restrictions, and that in turn has meant that, once again, up to a couple of months ago, better economic outcomes. This chart shows the change in unemployment from the start of last year. By May this year, we had our unemployment rate back below where we were. All those various grey lines are other OECD countries. So we've really ticked the trifecta. Looking backwards. The tricky bit is looking forwards. So to make the obvious point, the first problem is this is the race that's stopping the nation, the vaccine rollout. And for whatever reason, we are lagging, and that's slowing down our recovery. If this was the only issue we faced, it would simply be a matter of time. As we caught up, we could look to enjoy UK-style opening. But that's not the case. There's two issues where politics are going to play a huge role in dictating the pace of the opening up. The first is what our premiers will do. They've been politically rewarded for an aggressive zero tolerance approach to COVID. The problem is zero tolerance is completely incompatible with any sort of opening up, even if you have high vaccination rates. This table shows one of the scenarios mapped out by the famous Doherty Institute, and this was the basis of the plan agreed to by the National Cabinet. Of course, no one's going to die in a ditch defending the precise numbers here, but let's take them as roughly right. What the numbers in the body of this table are showing is the Doherty Institute's estimate of the medical fallout over the first 6 months after community transmissions commences under those different vaccination scenarios. So even at the 80% scenario, 6 months after a breakout, you'd be looking at 2,000 ICU admissions and over 1,200 deaths. And my question, simply put, is will the premiers find that acceptable? And if they don't, and they may not all agree, some may not, we could have ongoing restrictions between the states and within the states as they try and achieve better outcomes than this modelling suggests is likely with vaccines widespread. So this is the first inherently political issue that clouds the outlook for Australia. The second issue, let me introduce it in a rather circuitous way, and it goes back to what was really our biggest macro problem in the aftermath of the GFC, and it was the stagnation in incomes. This chart shows two measures of individual income. The jumps over the last year are obviously the transfer payments from the government. The point is the 7 or 8 years before that, which we saw flat income growth. Now, that also frustrated the RBA's inflation target. There is a relatively close link between labour costs and inflation, and this gets to the RBA's argument that it won't be tightening monetary policy until it sees wage growth consistent with its inflation target. That sweet spot is around 3 to 4% labour cost increase, which is consistent with the RBA's target of 2 to 3%. The reason we've been unable to get that sort of labour cost increase in the post-GFC cycle, I thought was relatively straightforward. We had too much labour supply. This chart shows the historical correlation between underemployment on the horizontal axis and wage cost on the vertical. Just ignore the red dot, which is where we are today. It's that cluster of numbers, those dots, around 8 to 9% on the horizontal axis, which was the post-GFC period. We had underemployment around 8 to 9%, and that led to nominal wage growth of around 2%, which translated into real wage growth of almost nothing. The good news is we could well be looking at wage growth rising quite sharply. This chart shows in blue the labour cost index as reported by corporates to the quarterly NAB survey, and you can see that huge lift. Taken literally, and I don't think we'd see as aggressive a wage increase as this chart literally implies, but if we were, we could see wage growth running at 4% in the middle of next year. i.e., we could, by the middle of next year, see wage growth absolutely in the RBA's sweet spot and the RBA starting to tighten. So what's caused this dramatic turnaround? After a cycle where we've been unable to generate almost any wage growth, how come all of a sudden we're doing it now? Well, I think the answer to this question is also relatively straightforward. Labour supply is driven up. We've seen a collapse in labour supply courtesy of the border closure, the international border closure. This chart goes back to the 1950s. In actual fact, the growth in the working age population is now the lowest since just after World War II, when ironically we had the Spanish flu come through. This gets to the heart of the second political issue. If border closures are driving this reduction in labour supply, and that is potentially leading to a surge in wages, RBA policy outlook is now hugely dependent on whether or not we keep the borders closed. And my sense is that we will see the borders reopen quite soon after the federal election. The federal election can be delayed until May, but you're potentially looking at the borders reopening in the second half of next year. There's also a sub-question of whether they'll reopen as fully as they were open prior to the pandemic. But this is the second big issue where politics intrudes onto the outlook for the economy, for interest rates, and ultimately for equities. Before I talk about markets, I will just make a couple of very quick points that aside from all this pandemic-related uncertainty, many other indicators are actually quite upbeat in Australia. Housing is looking very strong. It's not just house prices. The lift in dwelling approvals always gives a good lead on the housing contribution to GDP, and that's pointing to a rising contribution ahead. Most promising is the pickup in leading indicators of business investment. The red line here, which is a leading indicator, is now as strong as it's been since the aftermath of the 1990s recession. As an aside, I think this may also be connected in part to the closure of the border, because firms that are running out of labour are resorting to CapEx, which is a good thing. It's going to boost productivity. The other thing I have to say about this is, given where business investment is at the moment, every which way is up. This chart just shows non-mining business investment as a share of GDP. Historically, in recession lows, non-mining investment typically falls to around 8.5%, 9% of GDP. Over the last decade, we've averaged 8%, and where we are now over the year to March, non-mining investment is at the lowest share of GDP in the post-war period. We've had an appalling decade for investment spending. So, as I said, from here, every which way is up. The other good news is the labour market does look strong, running out of workers. has encouraged demand in terms of job vacancies. The blue line in this slide, it is literally off the scale. That's slightly base effects, but every indicator of labour demand tells you that people are looking desperately for workers. And finally, the consumer sector has a nice little nest egg. What we saw in the pandemic was income, the red line in this slide, jump, courtesy of government handouts. Spending, the blue line, dipped. And that meant that we saw saving rise. And in fact, we saw an unusual amount of saving. I think the excess saving that the household sector has trousered is around 165 billion Aussie dollars, or about 12% of annual income. That's a nice little nest egg. So what's the outlook for markets? Well, rate markets are expecting that the RBA will need to start tightening some stage in 2023. That's earlier than what the RBA has been signalling. It's been saying 2024 or after. And my view is the rate market's right, subject to those risks around the pandemic. If we have rolling border closures and a reopening of the foreign border in the second half of next year, this may be wrong, but I do think the RBA is going to struggle to delay tightening interest rates until its sort of 2024 time horizon. Much like the rest of the world, I think there's a story to rotate into more cyclically sensitive sectors in Australia. A very simple way to split the local market is to look at mining versus the non-mining piece. The non-mining piece still looks quite expensive relative to its own history. Where it was at the start of this year was as expensive as we've seen. Really, you'd have to go back probably to 2000 to get it more expensive. The miners keep on getting cheap, which is partly a reflection of their surging earnings. And much like I showed you globally, I also think the expensive winners of the last cycle, which were the growth stocks, they have derated a little, but they still look quite pricey. And if we were to see rising rates, particularly rising bond yields, and Aussie bonds tend to move almost in lockstep with US bonds, that part of the market could be quite vulnerable. So, in summary, if we see no more major COVID surprises overseas, and I've got no edge on whether we'll see any new nasty variants, I think 2022 is looking a great year for global growth. It will be a different recovery from the post-GFC. This one will be led by developed markets, not emerging markets, but it's going to be a strong growth year. That means I think long rates are going to have to start to rise. The recent declines, I think, are a bit of a head fake. And I think the world's most important central bank, the US Federal Reserve, will need to tighten either late 2022 or 2023. The outlook for equities over the next 12 months, there's always the prospect of a correction. Equities are ahead of themselves. But I think the much bigger story is the potential rotation within the equity market, where, to boil it down, the reflation trade lives on. Another way to describe that is that many of the winners of the post-GFC cycle, which was your highly valued tech stocks and bond proxies, will start to lose out relative to the losers of the post-GFC cycle, which were financials, cyclicals, and resource companies. Here in Australia, we do have some positive fundamentals, but gee whiz, the outlook really is complicated by these policy uncertainties relating to how we get out of this COVID situation. And then finally here, I think in an equity context, we will follow the trend set by the US, reflecting the rising bond yields, that we will also see rotation. With that, I will hand it back to Paul.
Thanks, Jared. As always, you've provided some wonderful insights. The year ahead, undoubtedly will be interesting for more reasons than one, but should be, I think we both collectively think, broadly positive. You have, however, highlighted the risk of emerging inflation. History tells us that central banks do tend to have a poor track record in raising rates, pretty good track record of lowering them. So it'll be interesting to see how this plays out towards the end of 2022 and beyond. We have allocated some time for Q&A, and we do have some questions. So first of all, a question from Alex, which was, how do you see the ongoing impact of a very tight transport sector and extraordinarily strong rises in freight costs?
Look, these are important for industrial sector prices, but you'd be surprised how little that can feed through to consumer level inflation. It's a factor, but by the time a good gets to a consumer's hands, the cost of that transport, be it freighting it from Shanghai to the west coast of the US, and those freight rates I think are up by a factor of 7 or 8 times over last year. That gets washed out by a lot of other things. So it's got consequences for individual industries, less so for consumer level inflation. The other point I'd note is I suspect that this is a classic example of a price that should start to fall next year. Some of the pressure points that did take people's eyes over the last 12 months have already started to reverse. One of them's lumber. Lumber prices quintupled in the US, but they've now more than halved from their peak. So these blockages that have led to spectacular price increases can be removed quite fast, and then prices drop back down.
Great. A question from Peter. With the extent of stimulus and particularly the extent of infrastructure spending, of which we've had the first, if you like, bilateral package, potentially the democratic package. Just how do you see the relationship between the stimulatory impact and earnings growth, and how that necessarily trades off in terms of pressure in terms of inflation and bond yields and valuation? So it's really, on one hand, Jared, do you think that the EPS uplift that stimulation can provide is sufficient to outweigh potential increases in bond rates?
Great question. History says that through the bulk of a cycle, you normally do get earnings growth enough to offset some compression in valuation. The really big downdraft in equities typically requires a recession. This time may be a little different, and the reason it may be a little different is that US valuations are starting from such extraordinarily high levels that may make the US unusually vulnerable to derating if we do see bond yields rise. But even in the US is a microcosm of what's true globally. Just as I mentioned in the presentation that US equities look expensive relative to the rest of the world, so the rest of the world's probably less vulnerable to rising rates. If you look within the US market, the high valuations are concentrated in a relatively small number of stocks. They're enormous stocks, so it's quite a big part of their market cap. A lot of the beneficiaries of a strong cycle that would be the classic beneficiaries from an expansion infrastructure, I won't say they look cheap, but they're absolutely at levels, valuation levels that shouldn't be an enormous headwind if they get strong earnings growth. In other words, I think there's a huge part of the market over there, the cyclical part, the financial part, that will absolutely give you positive returns, even if there's some moderate derating. The part that's most vulnerable to this scenario of a stronger cycle with rising rates is the winners, the FANGs, but the expensive big tech. They're the ones that look most vulnerable to derating if bond yields rise.
Yeah, and we'd concur with that, and particularly our focus is really on those smart industrials, the ones that employ technology, but are well leveraged to that cycle uplift.
Yes, I mean, one way I put it is, in the post GFC cycle, when earnings were scarce, not many companies could generate it. Investors, jumped into the handful of companies that could generate earnings. Whereas this cycle, because it's going to be a lot stronger, in my view, the ability to grow earnings won't be scarce, and what investors will be looking for is operational leverage. That is, the companies that can best grow their earnings in a strong cycle. And that sounds like it fits with the sort of companies you've been looking for, Paul.
So we've got this positive outlook, saving except for we can't go anywhere and we can't move. But despite that, we do have that positive outlook. We do see these emerging inflation risks. We see that potentially in terms of rising bond yields. A question's been raised, Gerard, given that, why have we got declining long bonds at the moment?
Well, that's a puzzle. Look, the way I've looked at what's happened is there was initially a moderate fundamental justification for a decline in yields, but that decline got enormously magnified by some technical factors. Now, here, let me focus the discussion on the US because that's been what's driving global bond markets. The factors that justified some pause in the increase in yields, and just to back up, I mean, 10-year Treasury yields were 50 basis points, 0.5% in August last year. By March of this year, they'd got to 1.75%. I mean, that's an enormous proportional rise. And even I thought at that stage it was right for a pause and a consolidation. But then a few things happened. The US macro data started to disappoint versus expectations. Now, expectations were very high, but still we saw disappointment. But then we had uncertainty about the Delta strain, and it was probably quite fair to sort of take a step back and assess what that may do to the expansion. But that doesn't justify bond yields falling from 1.75% down to 1.1%, which is what they did. So then you're looking at other factors, and I'll rattle off two or three. One is the attraction of US Treasuries to foreign buyers increased enormously. This is not just a matter of the yield. There's also the cost of hedging for a foreign buyer. And you can calculate, for example, what yield a buyer in Japan or Europe would get on owning a 10-year Treasury in the States if they fully hedge things. And that yield by March this year got to its highest level since 2016. And that then prompted a massive switch in foreign demand for Treasuries. Foreigners had sold a truckload. Foreign selling of Treasuries last year was the largest ever. This year, they've come back with a vengeance buying. So that's the first thing. The second thing is the Fed was gobbling up all the Treasuries being issued to fund the deficit. So there was actually no extra supply coming onto the market. Thirdly, a lot of the punters, the speculators, had come into this year positioned for further increase in bond yields. That is, they were short the market. Basically, they were short and caught. Once yields started to fall, that is, the price of bonds go up, they had to buy more bonds to cover their position. So these are the sort of technical factors that have led to an overshoot. But I think ultimately the fundamentals will dictate where this story goes. And if we have ongoing strong growth into next year with rising inflation pressures, there's no way US 10-year yields are staying where they are today.
Great. Gerard, I think, again, that it's been a fantastic coverage this afternoon. In the interest of time and people's lunchtime at the kitchen bench, because that's about as far as they can go, I think we might pull up stumps. But again, we're very grateful for Gerard's time today. I'd like to thank all of you for your attendance. We've had an excellent agenda attendance today for this webinar. So, and I'd like to, of course, thank you for your ongoing support of Cameron Harrison. It goes without saying, I truly hope that we can meet again in 6 months' time in our normal face-to-face lunch format. But in the meantime, please reach out for discussion on any of the points raised or any other points you'd like to discuss. But above all, keep well and keep smiling. So thank you, everyone.
Thanks, Paul.
Cheers, Jared.